Hey everyone, it's Billionaire here, and let's be honest, the world of finance, it's kind of a roller coaster. Sometimes it's up, sometimes it's down, and sometimes, well, it crashes and burns like a Tesla on autopilot in a Guy Ritchie movie. But what if we could learn from those crashes? What if, by understanding the mistakes of the past, we could make the ride a little smoother in the future? That's what we're doing today, folks. We're diving headfirst into the chaotic, exhilarating, and sometimes terrifying history of financial crises. Our guide, Scott Nation's insightful book, The 5 Crashes Lessons from the History of Financial Crises. And trust me, this isn't just dry, dusty history. This is the kind of stuff that keeps central bankers up at night. This is the stuff that can make or break economies. And yes, even change the course of human history. Over 5 chapters, we'll journey through time, from the panic of 1907 to the 2008 financial crisis, dissecting the causes, consequences, and most importantly, the lessons learned from each heart-stopping plunge. So buckle up, grab your thinking caps, and get ready for a wild ride through the history of financial meltdowns. Our story begins in the bustling streets of New York City, 1907. A time of top hats, handlebar mustaches, and a financial system about as stable as a unicycle on cobblestones. Enter the Knickerbocker Trust Company, one of the city's biggest trust companies. Trust companies were like the cool younger brother of banks, dealing in all sorts of investments. But cool doesn't always mean stable. Knickerbocker got tangled in risky loans and speculative investments, especially in copper. When copper prices plummeted, Knickerbocker was left with worthless investments. Panic ensued. Depositors stormed the bank demanding their money back, but Knickerbocker's vaults were empty. The bank went belly up. The American financial system was incredibly interconnected. One bank's failure triggered a domino effect, sending shockwaves through the entire system. Amidst the chaos, J.P. Morgan emerged. He organized a bailout, gathering major bank heads to pool resources and prop up failing institutions. The Panic of 1907 led to the creation of the Federal Reserve System in 1913. The Roaring Twenties, a time of flapper dresses, jazz music, and a stock market that seemed to defy gravity. But as with all good parties, this one had to end. And boy, did it end badly. The 1920s were a period of unprecedented economic growth and technological innovation. The automobile industry boomed, radios became commonplace, and the stock market soared to dizzying heights. Everyone, from seasoned investors to shoeshiners, was pouring their savings into stocks, convinced that the good times would never end. It was the era of margin buying, where investors could purchase stocks with just a small down payment, borrowing the rest from their broker. It was like buying a house with pocket change, except riskier, much riskier. But this speculative frenzy couldn't last forever. The market was becoming increasingly overvalued, detached from economic reality. Companies with no profits, no products, and frankly no business being public were being bid up to astronomical valuations. It was pure speculation, a game of musical chairs with disastrous consequences. And then, the music stopped. On October 24, 1929, a day that would forever be etched in financial infamy as Black Thursday, the stock market crashed. The Dow Jones Industrial Average, a key barometer of the market's health, plunged by a record 11%, wiping out billions of dollars in wealth. Panic selling gripped the nation. Investors, desperate to salvage what little they had left, dumped their stocks, driving prices down further. The crash triggered a chain reaction, leading to bank failures, business closures, and widespread unemployment. The Great Depression had begun. Chapter 3, 1987, when computers almost broke Wall Street. Fast forward a few decades, past World War II, past the Summer of Love, and land smack dab in the heart of the 1980s. A time of shoulder pads, big hair, and you guessed it, another stock market crash. But this time, there was a new kid on the block, a technological marvel that promised to revolutionize trading, the computer. See, in the early 80s, Wall Street, once a place of shouting traders and frantic hand signals, was rapidly embracing the power of computers. These weren't your clunky Commodore 64s either. These were high-powered machines capable of executing trades in milliseconds, using complex algorithms to exploit market inefficiencies. It was the dawn of algorithmic trading, and it was about to get a very public, very chaotic test run. On October 19, 1987, Black Monday, the Dow Jones Industrial Average plummeted by a staggering 22.6%, the largest one-day percentage drop in history. One of the main culprits was a trading strategy called portfolio insurance. This computer-driven strategy, designed to limit losses in a falling market, backfired spectacularly. As the market started to dip, these programs automatically triggered sell orders, creating a cascade effect that drove prices down even further. The crash of 1987 was a stark reminder that technology, while powerful, can also amplify our mistakes. Chapter 4: The dot-com bubble, when the internet went bust. The late 1990s. The internet, that digital Wild West, was exploding in popularity. Investors, blinded by the promise of the internet, poured money into anything with a .com at the end of its name. Companies with no profits, no revenue, and sometimes no clear business plan were going public to valuations that would make even the most seasoned investor blush. Pets.com, anyone? They delivered pet supplies, which was great, except they lost money on every single sale. But just like the laws of gravity and the inevitability of awkward teenage photos resurfacing on the internet, what goes up must come down. And in the spring of 2000, the dot-com bubble burst with the force of 1,000 dial-up modems disconnecting simultaneously. The Nasdaq, home to many of these high-flying tech stocks, plummeted, erasing trillions of dollars in market value. The dot-com bubble, much like a poorly coded website, crashed hard. Chapter 5, 2008. The subprime mortgage crisis, a house of cards built on debt. The early 2000s, a time of low interest rates and questionable lending practices. Banks were handing out mortgages like candy on Halloween. These were subprime mortgages, loans given to borrowers with poor credit histories. Wall Street bundled these risky mortgages into mortgage-backed securities, or MBS. Think of it as blending questionable loans and convincing investors it was a low-risk investment. These MBS were sold to investors worldwide, spreading the risk. But housing bubbles always burst. And burst it did. In 2007, the housing market cooled, and it all came crashing down. Borrowers began to default on their mortgages. MBS became toxic assets, their value plummeting. The 2008 financial crisis was a brutal wake-up call. Outro: lessons learned? Hopefully. From the panic of 1907 to the 2008 financial crisis, we've journeyed through a century of financial booms and busts, witnessing firsthand the devastating consequences of unchecked speculation, regulatory failures, and plain old human greed. We've seen how seemingly small events can cascade into full-blown crises, how innovation can be both a blessing and a curse, and how the choices we make, both individually and collectively, can have profound and lasting impacts. But amidst the wreckage of these financial meltdowns, there's a glimmer of hope. Each crisis, as painful as it may have been, has taught us valuable lessons about the importance of regulation, the dangers of excessive risk-taking, and the need for a more stable and equitable financial system. The question is, will we heed these lessons? Only time will tell. Thanks for watching. If you found this video informative, don't forget to like, share, and subscribe for more deep dives into financial history and other fascinating topics. See you next time.